If you worry about corrections, you shouldn't own stocks. I mean, if you can't take your stock going, it's going to go down sometime if you own a stock, so why worry about it?
Welcome back to the channel. Andrew Ferguson here. Let's get into Warren Buffett's 7 rules for successful investing. Start with number 1. Investing is about your temperament, not your IQ.
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd, because this is not a business where you take polls. It's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you, and you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
Rule number 2, market corrections happen and you need to be able to deal with them.
If you worry about corrections, you shouldn't own stocks. I mean, if you can't take your stock going, it's going to go down sometime if you own a stock, so why worry about it? I mean, the point is to buy something that you like at a price you like, and then hold it for 20 years. And you should not look at it day to day. If you bought a farm or an apartment house, you wouldn't get a quote on it every day or every week or every month. So it's a terrible mistake to think of stocks as something that bob up and down, and you should pay attention to those bobs up and down.
Rule number 3, keep building a database of information in your mind.
You know, I would read financial publications. I would read whatever was of interest to me. I'd be curious about how the businesses around the town of Kearney operated. I would, to the extent that you can get people to talk to you, and people usually like to talk, you know, learn about who's got good businesses in Kearney and why they're good businesses, and learn about the businesses that went out of business and why they went out of business, and just keep accumulating knowledge. That's one of the beauties of the business that Charlie and I are in, is that everything is cumulative. The stuff I learned when I was 20 is useful today. Not necessarily the same way and not necessarily every day, but it's useful. So you're building a database in your mind that is going to pay off over time.
Rule number 4, there is always a reason to not invest.
Where they're cheapest, you could find an equally impressive number of negative factors. I mean, you could have sat down in 1974 when stocks were screaming bargains, and you could have written down all kinds of things that would have caused you to say, you know, the future is just going to be terrible. And similarly, at the top, you know, or any time you can write down a large list of things that would be quite on the bullish side. We really don't pay any attention to that sort of thing. I mean, we have, you might say that our underlying premise, and I think it's a pretty sound underlying premise, is that this country will do very well, and in particular, it will do well for business. Business has done very well. You know, the Dow went from 66 to 10,000 plus in the 100 years of the 20th century, and we had 2 world wars and nuclear bombs and flu epidemics, and you name it, Cold War. There's always problems in the future. There are always opportunities in the future, and in this country, the opportunities have won out over the problems over time, and I think they will continue to do so.
Rule number 5, wait for your pitch.
American corporations offered you at a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients will start yelling, "Swing, you bum!" You know, from the stands, and that's very tough for people to do.
Rule number 6, Starting early is a huge advantage.
Have something to work with. I mean, I was fortunate in that respect because my dad paid for my education. If he hadn't, I probably wouldn't have become educated if I had to pay for myself. But so I was able to save $10,000 by the time I was 21, and that was a huge head start. Every dollar then is worth making $10 or $20 later on.
Now, before we get into our bonus tip, rule number 7 is that the stock price does not matter.
Prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
And now for the bonus investing tip of the day from Warren Buffett, the best investment you can make.
By far the best investment you can make is in yourself. I mean, for example, communication skills. I tell the students that they're going to graduate schools and business, and they're learning all these complicated formulas and all that. If they just learn to communicate better, both in writing and in person, they increase their value at least 50%. I mean, if you can't communicate, somebody says, it's like winking at a girl in the dark. Nothing happens, basically. And you have to be able to get forth your ideas, and that's relatively easy. I did it myself with the Dale Carnegie course. Some people wish I'd taken a shorter course now in terms of my talking later on, but it's just hugely important. And if you invest in yourself, nobody can take it away from you.